Everyone thinks they can time bottoms and tops in the market, but clearly they fail to actually execute. Why is that? Well, because they rely on lagging indicators that everyone else is already using. But imagine being able to buy Bitcoin at 17K in 2022, or under 4K during the COVID crash, or at 30K in the summer of 2021. And not because you're lucky, but because your system told you exactly when to pull the trigger. Well, good news is you don't have to imagine anymore, because in this video, I'll reveal the multi-layered game of timing markets and uncover the exact framework that big money uses to identify crypto bottoms. By the end of this video, you'll understand not just when to buy, but why, and you'll have the confidence to actually act when everyone else is paralyzed by fear. This is the case because after extensive research, I found that to accurately spot bottoms, we need to look at three critical layers that directly interact with each other. The first is the macro environment and its indicators. The second is the on-chain data, and the third is the market sentiment. As we stack each layer on top of each other, you'll see how the real power exists when signals from all three of these layers align. That is where you'll find those buying zones that have historically led to life-changing returns. Okay, so considering that, let's start with the macro layer. The most useful way to think about macroeconomics as a whole is as the Bitcoin cycle's engine. Like, macro factors literally decided the top in 2021 and made the 2022 bear market bottom painfully obvious. You see, if you're trying to find a bottom just by looking at a Bitcoin chart, you're playing checkers in a chess match. Bitcoin doesn't move in isolation. It moves with global liquidity. So for example, in 2023 and 2024, many analysts predicted that Bitcoin and stocks couldn't possibly reach these new highs because they only looked at headlines about higher for longer rates and significant quantitative tightening without understanding the bigger liquidity picture. So what many missed is, while the Fed controls rates in its balance sheet, the banks are the real money printers, because banks get to utilize fractional reserve banking to create up to 20x leverage on their reserves. And because of this, smart money went long in 2023 and 2024 when they realized the enormous pool of repo reserves would allow banks to continue lending despite quantitative tightening and high rates. So clearly this stuff can get complicated and noisy, but how do you actually cut through that noise for signal? Well, to give yourself a real chance to identify market bottoms, you need to look at the full liquidity picture through these three macro lenses: interest rates, the money supply, and the strength of the dollar. So let's break this down simply. First, we've got to talk about interest rates. So price doesn't react to the current liquidity conditions. It actually reacts to future conditions. Interest rates have a gravity that all other assets have to compete with. Higher rates literally pull liquidity into bonds and other safe assets, while low rates push investors towards riskier assets like Bitcoin. So what sophisticated investors understand is that the markets price in these expected rate changes 3 to 9 months in advance. So for example, in 2019, Bitcoin started rallying when markets began pricing in future rate cuts and the ease of quantitative tightening, not when it actually happened. In general, Bitcoin likes rate cuts as long as the Fed isn't cutting because of some economic crisis. So now let's quickly talk about the second macro indicator, the M2 money supply. This measures all money circulating in the economy, and Bitcoin has a pretty fascinating relationship with M2. Typically, there's like a 70-day lag or so relationship. So when M2 rises, it signals increasing liquidity, and Bitcoin eventually follows this wave upward. The third critical macro factor is the US dollar. Think of the dollar as a global liquidity valve. When it strengthens, it drains liquidity from risk assets worldwide. And when it weakens, liquidity is flooding back in. Well, why is that? Because the dollar is the world's reserve currency and the denominator for most global trade and debt. When you're buying Bitcoin, it's in USD, and a rising dollar makes dollar-denominated debt more expensive, forcing entities to liquidate other assets to service that debt. So that's why you've got to watch for those peaks in the DXY. Historically, Bitcoin bottomed soon after that. And the case in point would be 2020. After the DXY reversed in March of 2020, Bitcoin went on to 10x. So when you see these three macro forces align, dovish rate outlooks, rising M2, and a weakening dollar, you're witnessing the financial system actively reflating. And this creates the perfect environment for Bitcoin's most powerful rallies. Now, obviously, these macro signals don't give you the exact day or time to buy, but they do tell you when the conditions are finally working with you, not against you. So that was only the first layer. To get accurate bottoming signals, we need to dig deeper into the next layer to pinpoint the optimal buying zones. So if macro is like that weather forecast, then on-chain data is your radar. It tells you what's happening right now and reveals what traders are actually doing, not just saying on social media. But what on-chain data is actually important? Well, there are 5 on-chain indicators that slice through all the noise and give you the clearest signal. The first of which is the MVRV Z-score. So imagine if you could see the average purchase price of every Bitcoin and compare it to the current price. Well, that is essentially what the MVRV Z-score actually is. MVRV compares Bitcoin's market value to the average price that coins were last moved at. When MVRV drops below 0, it means that coins are trading below that average cost basis. And that is the undervalued zone. And oftentimes, it's an incredible buying opportunity. So the next on-chain signal is the PUL multiple. This one tracks miner revenue versus historical norms. Miners are often forced sellers, especially when their revenue dips, so they have to sell some Bitcoin. And when the PUL multiple drops below 0.5, it's a strong sign of miner capitulation. And every major Bitcoin bottom has occurred during or shortly after this signal fires. So next up we have SOPR or SOPR. This shows whether people are selling at profit or at loss. When SOPR is less than 1, people are panic selling. And when SOPR starts to rebound after dipping below 1, it's often the mark of the end of that capitulation period, generally signaling a decent buying time. And so now the fourth is open interest, which is absolutely underutilized. Open interest is the number of open derivative positions. So when price falls and open interest drops sharply, it means leveraged traders are getting wiped out. These flushes often coincide with local bottoms as sellers get exhausted. So last but not least for the on-chain indicators is the hash ribbons, which tracks the computational power securing the Bitcoin network. When miners shut off their machines during market stress, the hash rate drops. And when they turn them back on, it often signals that the worst is over as confidence is returning. So when the 30-day moving average of the hash rate crosses above the 60-day moving average, it shows that miners are coming back online after a capitulation event. Historically, every hash ribbon buy signal has preceded a major move upward. Yeah, this might sound complex and hard to track, but what if I told you there was a way to track them all at once? And this is where the CBBI comes into play. The CBBI, which is built by Colin Talks Crypto, aggregates 9 indicators, which includes many that we just talked about, like the MVRV Z-score, the PUL multiple, and then a few others as well, including the R-HODL ratio, RUPL and NUPL, Pi cycle tops, reserve risk, and others. This gives you a very simple aggregated score from 0 to 100. Low is undervalued and high is overheated. So to break this down, the RUPL/NUPL, which is the RUPL NUPL, tracks unrealized profit and loss in the network. And the R-HODL compares recent versus long-term Bitcoin holder behavior. So I really love to use those two paired with the PUL multiple and the MVRV Z-score for the CBBI. And this removes many of the lagging indicators to build a really responsive indicator to identify these buying opportunities. Okay, so now that we've got the macro and the on-chain signals aligned, we need that one more layer to confirm our entry. And the final layer reveals what the market is actually feeling. This is often what separates the good entries from the great ones. Like, for example, some of my most profitable Bitcoin investments came when it physically hurt to press buy, when literally every headline was negative, when friends thought I was crazy, and when my own emotions were screaming, don't do it. So considering this, there are 3 sentiment tools that have been absolute game changers for my investment strategy. The first and most commonly known is the Fear and Greed Index. The ideal setup for the Fear and Greed is when the indicator hits extreme fear when our other layers are indicating bullish signals. So that's where you find those truly asymmetric opportunities. And for context right now, it actually sits between that fear and neutral zone, right around 45. But actually, it was just recently in that extreme fear window, which is what we're looking for. And the second sentiment indicator is social media sentiment tracking, and tools like Lunar Crunch can quantify what the crowd is actually feeling in real time. And that can be extremely useful. That key insight is that a bottom often forms not when everyone is panicking, but when they stop caring altogether. So just look for apathy, not just fear. And that's when the smart money is quietly accumulating Bitcoin over time. And speaking of smart money, the third is the whale accumulation patterns. So when large wallets holding 10,000 plus Bitcoin start accumulating while retail investors are selling, that's your silent confirmation that smart money sees value right now. And these divergences between retail sentiment and whale behavior often precede these major moves upward. So interestingly, whales holding over 10,000 Bitcoin have pushed their accumulation trend score above 0.5 recently, which is a clear sign of steady buying while small holders are continuing to sell. I mean, that is exactly what we're looking for. So overall, sentiment tells you when the crowd is offsides. And in crypto, fading the crowd is often the absolute best edge that you can have as an investor. So there you have it. You now have the framework used by the top 1% of crypto investors to identify bottoms with precision. The next time you see these 3 layers align, you should have the confidence to act while everyone else is frozen in fear. Here's another question for you. What do you do if these signals are indicating that danger may be ahead? Well, I actually made a video about altcoins that could survive or even thrive in a bear market. So if you want to find out what those are, just watch this video right here.